Hey guys, today I'm going to talk about trade execution, which is the art of selling and buying. This is very important to understand for anyone involved in trading. So, either whether you're a day trader or someone who's building automated trading systems, you need to have a grasp of trade execution, specifically what the costs involved are and how they are impacted by different market variables. So, that's what I will explain today. So, that said, trade execution is sometimes a lot more important than other times. So by explaining it, we will also go over some examples to see the difference about when it's important and when it's not really, and when you need to think about it more clearly than other times. And I will also go over how specifically Gekko approaches trade execution. Okay, so trade execution basically means buying and selling. There's not too much to it, but there are a lot of different ways in how you can approach this problem, and there are different types of buying and selling you can do. And in some situations, it's very important that you think about how you're going to execute a trade. So, to understand the dynamics of trade execution, I have a hypothetical situation. So, imagine that you have a strategy can only tell you when the price will go up 0.5%, so 0.5%. And then the question is like, can you use this information that you have about the market to make money? And keep in mind, right, like if you're able to make exactly 0.5% every time, like you're gonna double your money after 200 times, right? Like so, 0.5% doesn't sound like a lot, but this all depends on how often you kind of do it, right? Like maybe this situation where the price goes up 0.5%, like maybe that happens 10 times a day. In which case, after 20 days, you double your money. So I mean, just because 0.5% doesn't mean it's bad, right? However, the problem is that if you're able to predict the price changing 0.5%, going up 0.5%, you could say, okay, well, we're gonna buy, and then whenever it's 0.5% high, we're gonna sell again. But whether you actually make 0.5% or not depends on your trade execution. So basically, it depends on how much costs are you gonna have when you're gonna trade upon this information. Because if it's gonna cost more than 0.5%, like you won't be able to convert this into money, right? Like you can only make money by one, predicting the price and imagine you're always correct, and two, then being able to leverage to trade on that information with keeping the cost lower than the price prediction. So before we're going to look at some examples, like it's already clear at this point that whether trade execution matters or not. So imagine that the prices of executing a trade are between 0%, if you're really good, or if you have the perfect opportunity in the market, up until 0.5%. Say it's something like that, which in most liquidity scenarios is not very unreasonable. So whether this matters all depends on the type of strategy you're doing, right? So if you have a strategy that tries to predict price fluctuations of say like 10%, then optimizing for this 0.5% cost might not be as effective as like predicting crashes and these things like really big price fluctuations. So how important trade execution is, it 100% depends on the type of strategy that you're running. So in our first example, we're going to look at BitMEX. And I've chosen BitMEX specifically because it's a very liquid and voluminous exchange. There's a lot of trading going on BitMEX. And what this means in terms of trade execution is that you're able to get in and out of the market and in and out of specific products with very little costs. This means that your trade execution will have very low costs, which makes it great to do things it makes it great in situations where you have a strategy that only works over like 0.5% or even smaller increments like that. I will go over some examples in a bit. Because you're able to trade with very low costs. So in this example, we see the order book here on the left side, and the order book represents the current state of liquidity. This means like if you were to buy or sell right now, what would the costs associating with doing so be? I've made a video a few weeks ago about market making, which looks on the other side because most of the money in the order book is provided by market makers, also called liquidity providers. But now we're having a look at the other side, which is trading, right? Which is you wanting to buy some Bitcoin or you wanting to sell some Bitcoin for your hypothetical 0.5% strategy, right? So what we can see here is that if we were to buy right now, there are two ways by which we can buy. The simplest way is to buy from someone who is now willing to sell. So we can see there in the order book, right now there are a ton of people willing to sell, and the person with the lowest price is offering to sell for $6,512. And there's currently, as you can see here, right now between $200,000 and $400,000 willing to sell at this rate. So you can right now, if I look at this, I can go in and I can buy up to $300,000 worth of Bitcoin for this exact rate. But after that, like imagine I want to buy $1 million of Bitcoin, then there's not enough at this rate. So I will have to buy this rate and this rate and this rate, and it'll slip into the book. There's a bigger explanation of this in the market maker video, so do check that out if you have trouble understanding this. But this is called slippage. And slippage is one of the costs when you're executing, specifically when you execute with market orders. But as you can see, right, like in this scenario here on BitMEX, like if you were to sell right now, like you can sell $200 million without slipping. So whether slippage is a factor and how big of a cost slippage is depends on the liquidity of the market versus the size you're trading. So the other way of doing of trading, the other way of currently buying, is what you can do is you can place a bid at this rate here at 6,511.5. You can say I'm willing to buy $5,000 worth of Bitcoin on BitMEX, and then if people start selling, they will start selling into this rate, and at some point they're gonna sell into you, and then you will buy. And what you will note is that you will buy at a better rate, right? Like if you were to buy right now from someone who's selling, you'll be paying 6,512. However, if you're able to put the limit order and then you buy, then you're able to buy for a lower price, which is a better price if you're buying, right? Like if you buy, you always want to buy at the lowest price. So what you can see here, the spread, which is the difference between those two. In a lot of scenarios on BitMEX, it's only half a dollar. Basically always when you can trade. Because if there's not half a dollar, there are overload problems and you can't trade. This means that it's only half a dollar. And half a dollar in Bitcoin price, right? It's very little. It's very little. You're talking about less than 0.01%. So the spread is another cost, which only really matters if you do some forms of orders like market orders. Because with a market order, you go and you buy from someone who's currently willing to sell. So you have to cross the spread, as it's called, which means you have to pay the spread, right? Like. Right now you have to pay 6,513 if you buy straight away, but if you're willing to wait a little bit and you're lucky by placing a limit order here, like you basically get a 50-cent discount per Bitcoin, which is not very much. But yeah, so those are the two big costs associated with trading if you want to do a market order. So that's spread and slippage. So now let's have a look at Binance. And I specifically chosen the market called Nulls USD Tether, which is the market on Binance with the least amount of volume. And usually you will find that markets with very little volume have terrible liquidity. Again, if you want to understand this dynamic, I refer to the other video on market making, which you can find in the description. But this means that if you're trading on Nulls USDT, unfortunately, it's going to be harder to trade. Like if you were to buy right now, the only way we can do that is to buy with a market order. And as you can see here, the best price someone's currently willing to buy at is 1.172, where the best price someone's currently willing to sell is 1.17. Okay, so what we can quickly see here is the difference. So the difference right now between the sell price, which is 1805, and the buy price right now is 1727. So this is a little formula that calculates the difference in percentage. So as you can see right now, the percentage difference here is more than 0.5%. So if you go back to our strategy, like we have a strategy that can predict the price movement of nulls, and it can tell us when the price of nulls will go up 0.5%. Well, in this situation, like we can't do a market order because a market order is already more like the cost of only the market order, like crossing the spread, is already more than 0.5%. And then, like at that rate, we can only buy 80 nulls. So what if we, I don't know how much a null is. Oh, a null is $1, I can see here. So if we want to do this with like $1,000, like we're gonna slip even further, right? We're gonna slip all the way up here, up until like something like 1815, which is this is 0.75%, right? Like, so there's no way in hell we can make money on this specific market by doing market orders, because the costs associated with those are like almost 1%. So it only really makes sense to trade this market if you have some kind of a strategy that is going to predict price movements bigger than like 1%. If you're going to rely on market orders, but you can also say, you know what, I'm just going to do a limit order. I'm just going to put my order in right here, and I'm going to hope someone will sell into my limit order, and then I don't have the two costs of crossing the spread and eating into the slippage on the other side of the book. You don't have these problems anymore. However, if you do a limit order, if you say, that's basically you posting an ad saying I'm willing to buy, well, whether that actually happens depends on whether someone else will come along and see my ad and say, you know what, I will sell to you. And that brings us to another risk, right? Like, let's go back to BitMEX, just because stuff is moving a little bit more. And let's zoom all the way in. Yeah, so now the market is actually quite balanced. But what you will see in a lot of cases, like I'm pretty sure if you wait around for a little bit, you will see happen. You will see that there's a lot of, here, right now we can see it happening. Right now there's a lot of sell pressure, because there's, on this side of the order book, there's 1.4 million, where here there's only 150,000. So what this tells us is that if we want to sell right now with a limit order, we would put a limit order in here. Like it's very unlikely to get taken, because there's a lot of selling pressure, but there's not a lot of buying pressure. Like you can see that here as well reflected in the last trades. And the price is very likely to go down, because as soon as people go and buy up to, sell up to like $200,000, the price will go below this 6509. And in the case when you're selling, you always want to get the best price, right? So you don't want the price to go down, right? You want to sell before that happens. So if you were to put a limit order in, like this, you're gonna have the costs of the risk associated with the price moving against you. Yeah, and the same applies for nulls, but it's not really moving a lot, so we can't really see that happening. But if you were to put, say, I think nulls is gonna go to the moon. So I'm gonna buy 5,000 nulls. I'm gonna put a limit order in right here. Like chances are that before people will sell you 5,000 nulls, the price is going to push up. It's going to go higher. And then you're going to be left behind and you didn't actually buy yet. So that's another risk associated with doing limit orders. So let's bring this back to Gekko. So Gekko has an execution strategy. And the execution strategy of Gekko is to always do limit orders. So always stay on your side of the book. And this is mainly to not have to worry about the costs associated with slippage and crossing the spread, and then just wait until someone comes along. And if the price were to move up, so imagine that you have a Gekko strategy that says buy. Now Gekko would go ahead and place a bid, which is an ad to buy, hoping that someone will come along to sell. And if when that happens, the price moves up, it's gonna replace the buy to always be at the top of the order book, meaning offering the best price to currently buy at. And as stated before, like there's a risk associated with that, right? Because if the price moves against you, but if you're willing to buy right here, but then the price spikes up all the way to like $2, like to $2, you're gonna be like you're gonna be wishing that you did a market order instead, right? Because while there are fees, the costs associated with doing a market order, at least you're in straight away, right? Because like if I click market order right now, if I do a market buy, I'm gonna buy straight now, right now. And if then the price moves up in 5 minutes from now, then it doesn't really matter that I paid some money there, right? Like, so I paid 1% or 0.75%. But if the price is gonna move up like 10%, it doesn't really matter. So putting this back to Gekko, Gekko works on a lot of different markets. And Gekko doesn't really care about the market. So you can trade nulls USD Tether if you want with Gekko, but you can also trade a very liquid market, like on Bitfinex, for example. You can trade dollar Bitcoin, which is probably the second most liquid market after BitMEX, which is very different cost characteristics. And because a lot of people who are kind of new to the space and don't really understand trade execution are using Gekko, I'd rather be safe than sorry. Because if you're trading on illiquid markets, which a lot of people do, it's very, very tricky to do market orders. Because there are definitely situations where you can just pay up like 2 or 3% straight away in a very illiquid order book. And that way you'll just blow through all your money really quick. So that's the reason why Gekko is very conservative and it uses limit orders. That said, I am working with on other systems. Like I'm doing a lot of market making, where trade execution is extremely important, and you're dealing like it's not even about 0.5%. Like I have a system running right now that's trying to make 0.1% a day by doing a lot of trades, and I try to average each trade out to make like 0.02% a trade. So as you understand, trade execution is super, super, super important. So what you then do, and Gekko doesn't support this because it's a very, very hard problem to solve. What Gekko does, Gekko looks at the order book here, the state of the order book. It will look at the historical flow of trades. So this here is called trade flow, and this here is called order flow. So the state of the order book and how it's changing, and you can look at that to try to make some predictions. Like as you can see here, like right now the price is pushing up. So you can see, well, I think it's likely the price is going to go up, so therefore I think it's safe to do limit orders. Because I think the chance of the price moving against me are not very likely. But that said, with Gekko, I'm pushing people towards building strategies that rely heavily on the big alpha, meaning that you try to make strategies that predict price movements of like 5 or 10%, so you don't have to worry about this problem as much. But still, because some people, they do make minute-based strategies, which you can do with Gekko, but it's very dangerous because Gekko doesn't really help you out very much. But Gekko will refuse to do market orders because it's just too dangerous. I will slowly introduce some better controls over trade execution, but it's very, very dangerous because if the fees are if the costs associated are 3%, and you build a strategy that's going to trade 10 times a day, like you're just going to lose all your money in 2 days. And I don't really want people to do that, which is why I don't really support it with Gekko. The last thing I quickly want to go over is fees, because so as we said, like the difference between the limit order and a market order, so the market order you have additional costs, right? You have two. One is cost on the spread, and one is having slippage if there's not enough liquidity at the top of the book. But there is another cost on some exchanges, but this really depends on the exchange. And that cost is fees. So on BitMEX, there's actually a negative fee when you do limit orders, meaning that you're actually going to get money. And then there is a fee for taking, which is market orders, which is 0.075%. So this is 7.5 base points, and this is minus 2.5 base points. And so the difference between doing those two orders is already 0.1%. Which means that if on BitMEX you think you can do it with a limit order, that you might have to move a few times, a few ticks, you're still going to get a better price, simply because of the fee structure. And then if you look at Binance, let's have a quick look here. In general, 0.1% trading fee. So with Binance, how it works is you pay fees based on your volume. So for most people, you're going to be in the general tier because Binance only gives you discounts once you start moving a lot of money. But once you start moving a lot of money, you'll see that they differentiate between maker and taker as well. So you will pay less being a maker. So this incentivizes people to do limit order, which means adding liquidity to the book. And this could incentivize you personally to also do maker limit orders even more. Right? Besides the other two costs, you generally want to do market orders since you're just in and out of the market and there's no risk and you don't have to wait around. But you can look at from their fee structure, you can see that they incentivize people to do limit orders. So this is the third big cost, but it's only on some exchanges. Yeah, so if you look on GDAX, for example, you can see that there's a maker fee which is 0%, so it's free to do limit orders. And if people then, if you offer a bid to buy and then people sell to you, then you won't pay any fee on that on the exchange side. And wherever if you do market order, you're going to pay 0.3%. So at 0.3% is actually, this is a lot, right? Like we were talking about a strategy that's able to predict 0.5% price movements. So you're able to predict that the price will go up 0.5%, which means if you buy now and you sell later, you might make some profit. But the answer on GDAX is always going to be no with my current fee, since you're going to pay this fee twice, right? Once to buy, once to sell, so that's 0.6%. So if you can predict price movements 0.5% on GDAX, you can never make money doing market orders up until you start doing more volume, right? If you do more than 10 million a month, then it's actually worth it. You can make 0.1% every time. So it's really important to take this into consideration when you're trading. But do note that when you're trading on a very liquid exchange like BitMEX, it doesn't really matter. Since there's so much liquidity that the big costs, which are costing the spread and slipping into the book, slippage, they're not really relevant since there's so much liquidity. They don't really notice them. But then if you're trading on some like really small market like Knowles, Tether on Binance, like you're gonna have spreads of like more than 0.5% already. So it's like it's gonna be very, very, very hard to make money unless you make strategies that perform over a longer time span and they're trying to look for price changes of like 5%, 10%, something like that. Yeah. So I hope it's a little bit more clear now, and I hope I also explained why Gekko has its conservative strategy.